Today I'm going to be teaching the DCF valuation and then going into a model to show you exactly how to conduct a DCF. So first off, what is a DCF? DCF stands for discounted cash flow. It is one of the valuation models we use in SMIC, and it is a method used to estimate the value of a company or investment based on the cash it is expected to generate in the future, adjusted for the time value of money. Now, a DCF is only as strong as its assumptions are made out to be, and there's a lot of them, and you'll see exactly what I mean by this later on in the video when working through the model. So there's 5 different steps in conducting a DCF. The first is study the target and determine key performance drivers. Essentially what I mean by this is you should have a strong understanding of the company before going into the model. You should understand how the company makes money, their competitors, and maybe some risks that they may be facing in the future. This is also the point of time when you'll be pulling the financial statements off of Bloomberg. And with those financial statements, you can analyze and see trends in the company's profitability, revenues, and expenses. Moving on to the second step is project future cash flows. Specifically, we're going to be dealing with unlevered free cash flow, which is cash available to both debt and equity holders. We're going to be projecting out future cash flows for a period of time. This period of time is referred to as the projection period. For mature, stable companies, this is typically a 5-year period, but for less mature or newer companies, you may have to project out further. The idea of projecting out future cash flows is to project them out until you believe the company reaches a steady state of growth. The third step is calculate a weighted average cost of capital, or a WACC. This is your discount rate that you're going to use to both discount the future cash flows and the terminal value with. The reason why we discount both these two values is because the concept of time value of money, which states $1 today is worth more than $1 in the future. The fourth step is determine a terminal value. The terminal value is the value of the company after the projection period, and it accounts for a substantial portion of the company's value that we solve for in the DCF. There are 2 widely accepted ways to calculate a terminal value. There's the exit multiple method and the perpetuity growth method. The 5th and final step is calculate present value and determine valuation. This is when we're going to be discounting both the future cash flows and the terminal value using that WACC. Then we're going to add up these 2 values to arrive at the company's enterprise value. Then we're going to solve for the company's equity value. With that equity value, we're going to divide it by total shares outstanding and get an implied share price. With that implied share price, we're going to compare it to the actual company's share price, and we can get an implied upside or downside with the company's DCF. Now, since there's so many assumptions that go on with the DCF, we're also going to create a sensitivity analysis table, and this will show if we were to change a couple assumptions, what the share price would look like. Now, I understand I just went over a lot, and you may be a little lost or confused, but I feel like when we're actually working through the model, all this will make a lot more sense. So we're going to get started. We're going to be valuing Microsoft. Step 1 is study the target and key performance drivers. On the left portion of the screen, I have their 2023 revenue segment breakdown. I pulled this from their annual report. Microsoft has 3 different revenue segments. The first is productivity and business processes. These are their Microsoft Suite subscriptions and their LinkedIn. Then you have their intelligent cloud. These are all their cloud services. Next, you have their more personal computing. These are their gaming and hardware portion. As you can tell from the chart, they're quite diversified from all their products and services. In the middle, I have their revenues for the previous 7 years. And you can see that they've been growing at a pretty substantial rate, and we can use this when we're projecting out future revenue in the company's DCF. On the right portion of the screen, I have their 2023 geographic revenue share breakdown. I pulled this because I wanted to see if Microsoft has entered other markets, and obviously they have, as close to 50% of their revenue in 2023 has came from countries outside the United States. So with all this information, I believe that we're ready with step 2. In step 2, we're going to be working in Excel. Welcome to step 2. Step 2 is project out future cash flows. Before we get started, I want to explain a couple things. For instance, this right here is referred to as historical period, and this is referred to as a projection period. The projection period are the years on our free cash flow we're going to be solving for. On our free cash flow is cash available to both debt and equity holders. And in order to solve for the company's on our free cash flow, we start with the company's EBIT. EBIT stands for earnings before interest tax. Now, to start with the company's EBIT, we first have to solve for it. We did so in our last SMIC DCF valuation model by starting at the top of the income statement and working our way down to the company's EBIT. So this looked like revenue less COGS, less operating expenses, less D&A, and now it's company's EBIT. However, we feel it's more accurate now to start at the bottom of the income statement and work way up to the company's EBIT. So starting with net income, we add interest expense, we add tax expense, and we arrive at the company's EBIT. To solve for the company's unlevered free cash flow, it is always the following formula. Starting with EBIT, you subtract the tax expense, arrive at EBIT. EBIT stands for earnings before interest after tax. Next, you add depreciation and amortization back. These are non-cash expenses. Subtract capital expenditures, subtract change in network capital, and you arrive at the company's unlevered free cash flow. This was just a brief overview of what we'll be doing in step 2. We're going to get started now. The first line item we're going to be looking at is revenue. Revenue is also referred to as the company's top line. This is at the top of the income statement. And revenue is all the cash generated in a company within 1 year. So we're first going to fill in the previous year's revenues off their income statement, starting with 2019. To fill in the rest of the historical period, you just shift right, Command R, and I'll fill in the following years. To solve for the company's revenue growth rate, the formula is this year minus last year divided by last year. This represents Microsoft revenue grew almost 14% between 2019 and 2020. To fill in the rest of the revenue growth rates for the historical period, just shift right, Command R, and I'll fill in the following years. To project out future revenue, I can do this in a multitude of different ways. One, for instance, is to take the average, so equals average. This is 14%. This represents the average revenue growth rate for Microsoft in the last 4 years, is 14%. If I want to use this for the rest of the projection period, I just link it. Shift right, Command R, and the following years will be 14%. Another way of projecting out future revenue is just to use your personal opinions. So say, for instance, in 2025, you may feel that Microsoft's going to do something big. Therefore, you want to reflect this in the revenue positively. So you increase the revenue growth rate in 2025. Or in 2026, you may feel that the economy might not be doing so hot. Therefore, you decrease the revenue growth rate in 2026. As long as you have an explanation for your growth rates, they work. To reflect the actual revenue figure with these corresponding growth rates, the formula is last year's revenue times 1 plus the growth rate. Shift right, Command R to fill in the projection period. This was projecting out future revenue by taking the average whole revenue figure for the previous 4 years, the average of these 4 years. Another way of projecting out future revenue is to go to the revenue growth page. And as I mentioned in step 1, Microsoft has 3 different revenue segments. So I'm going to individually project out each one, then add them together and arrive at the company's total revenue. So first I have to get the growth rates from every segment. I do this by taking this year minus last year divided by last year. Shift right, Command R. Since I'm going to be using the same formula for the 2 other revenue segments, I can just Command C, Command V, Command V. To project out these future revenues, I'm just going to take the average growth rate. So equals average. Link this, shift right. Reflect this up top by taking last year times 1 plus the growth rate. Shift right, Command R. Since I'm going to be taking the average growth rate for the 2 other revenue segments, I can just shift down, Command C, Command V, Command V. As I previously mentioned, to solve for total revenue, I just add up all these segments. So this segment, plus this one, plus this one. Shift right, Command R. Total revenue growth, it's just this year minus last year divided by last year. Shift right, Command R. I believe this way of projecting out future revenue is more accurate. Therefore, I'm going to use this for the rest of the model. So go back to the free cash flow page, delete these year's revenues, and link them to the revenues on the revenue growth page. Do the same thing for the revenue growth rates. And we can begin solving for the company's EBIT. The first line item is net income. Net income is also referred to as the company's bottom line. This is at the bottom of the income statement. And net income is all the cash generated in a company after all expenses have been deducted. So we're going to fill in the previous year's net income, so off their income statement. Shift right, Command R. To project out future net income, we're going to take net income as a percent of revenue. So net income divided by revenue. Shift right, Command R. We're going to take an average of these percents, like this. Up top, multiply revenue times this percent. Shift right, Command R. The next line item is interest expense. This is how much the company pays for their debt. This is also on their income statement. Shift right, Command R. We're also going to take interest expense as a percent of revenue. Interest expense divided by revenue. We're going to take an average of these growth rates. Or sorry, not as the growth rates, just average of the percent of revenue. So to reflect this up top, multiply revenue times this percent. Tax expense is how much the company pays for in tax. This is also on their income statement. Shift right, Command R. For tax expense, we're going to take this as a percent of net income. So this is just tax expense divided by net income for that same year. Shift right, Command R. We're also going to take an average of these percents. So equals average. Up top, multiply net income for that same year times this percent. Shift right, Command R. To solve for the company's EBIT, it's just a sum of all these line items. So equals sum. Shift right, Command R. And we can now solve for the company's unlevered free cash flow since we have the company's EBIT. The first line item we subtract is their tax expense. Now we don't have to solve for it because we already did so when we're solving for the company's EBIT. So I can just link their tax expense to the tax expense row. Shift right, Command R. Solve for EBIT, you just take EBIT and you subtract the tax expense. Shift right, Command R. And next we're going to be adding back depreciation and amortization. These are because these are non-cash expenses. Depreciation and amortization are the decrease in the book value of both tangible and intangible assets over their useful life. Tangible assets are the company's fixed assets. These are their property, plants, and equipment. And intangible assets are the company's patents or trademarks. We're going to work in the fixed asset page for this. We're first going to fill in their revenues from the free cash flow page. Shift right, Command R. We're going to fill in the previous year's D&As off their cash flow statement. This is underneath operating activities right here. Shift right, Command R. We're going to take D&A as a percent of revenue, so D&A divided by revenue. Shift right, Command R. We're going to take an average of these percents. To reflect this up top, you just multiply revenue times this percent. Shift right, Command R. And we're going to link these values back to the free cash flow page. So right here, link them back. Shift right, Command R. Next, we subtract capital expenditures. Capital expenditures are the funds to increase, replace, or expand the company's fixed assets. So if a company buys new machinery or a new factory, these are examples of capital expenditures. Go back to the fixed asset page and fill in their previous year's CapEx. This is underneath their investing activities, same as acquisition of fixed and intangibles. Now, I understand this is a negative value, but I will be making it positive. But when we're solving for the company's unlevered free cash flow in the free cash flow page, I will be subtracting it. All I did to make it a positive value was just add a negative sign in front of it. Shift right, Command R to fill in the historical period, and we're going to take CapEx as a percent of revenue. So CapEx divided by revenue. We're also going to take an average of these percents. Up top, revenue times this percent. We're going to link this back to the free cash flow page. So go back up and link the values. So next is a change in net working capital. Net working capital is how a company operates on a daily basis. Net working capital is also current assets minus current liabilities. We're first going to be solving or projecting out their COGS. COGS stands for cost of goods sold. These are the direct expenses associated with running the business. So we first have to fill in their previous year's COGS. It's the same as cost of revenue on their income statement. Shift right and R. We're going to take COGS as percent of revenue So COGS divided by revenue. Shift right, Command R. We're going to take an average of these percents. Up top, revenue times this percent. So now we can work in the net working capital page. We're first going to fill in the revenues and COGS from the free cash flow page. Shift right, Command R. And then since COGS is underneath it, you can shift down, Command D, pull COGS. If you're working off a Mac, you can double check this by clicking Fn F2, and you can see that pulled the right value. So as I previously mentioned, net working capital is current assets minus current liabilities. But with the DCF, with current assets, we exclude cash and cash equivalents. And with current liabilities, we exclude any short-term debt. So we're going to be working in the company's balance sheet for this because we're dealing with current assets and current liabilities. And the accounting equation for the balance sheet is assets equals liabilities plus equity. So fill in previous accounts receivable. Shift right, Command R. Same for inventory. Shift right, Command R. For other current assets, we're actually going to solve for this. We solve for this by taking the residual value between total current assets and these two line items. So fill in total current assets first. And then remember, with total current assets, we subtract cash and cash equivalents. Shift right, Command R. So then other current assets is total current assets minus these two line items. So we're going to do the same thing for total current liabilities. So first is accounts payable. Shift right, Command R. I didn't include accrued salaries and benefits just because I didn't find this on Microsoft balance sheet, but if it is included when you're working in your model, please include it. For other current liabilities, we're going to do the same thing. We're going to take the residual value between total current liabilities, and in this case, just accounts payable. So fill in total current liabilities. And remember, with total current liabilities, we subtract their short-term debt. Shift right, Command R. So other current liabilities is total current liabilities minus accounts payable. Next, we're going to start working the assumptions. First is days sales outstanding. That's how many days it takes the company to receive payment on a sale. Formula for this is accounts receivable divided by the revenue times 365. So almost 86 days to receive payment on a sale. Shift right, Command R. Days inventory outstanding is how many days stuff stays in the company's inventory before it goes out. Formula for this is inventory divided by COGS times 365. Next is days payable outstanding. This is how many days it takes the company to pay its bills. This is accounts payable divided by COGS times 365. For other current assets and other current liabilities, we're going to take this as a percent of revenue. So other current assets divided by revenue. Same for other current liabilities. For all these assumptions, we're just going to take the average. So equals average. Command D. Link it to here. Command D. Command R. Take an average. Same right here. So we can get started by solving for the future values of these line items. First is accounts receivable. It's revenue times days payable outstanding, days sales outstanding divided by 365. Shift right, Command R. Inventory is COGS times days inventory outstanding divided by 365. Other current assets, we take this percent of revenue, so revenue times this percent. To solve for total current assets, we just take a sum. And same thing for liabilities. So accounts payable, these are COGS times days payable outstanding divided by 365. Shift right, Command R. Other current liabilities is revenue times this percent. Shift right, Command R. We're going to take a sum of these two line items. Shift right, Command R. And we're going to bring current assets and current liabilities back to the free cash flow page. So go back up here and link the values right here. Shift right, Command R. Do the same thing for current liabilities. Shift right, Command R. To solve for net working capital, it is just current assets minus current liabilities. Shift right, Command R. And this is a change in net working capital. All that means is this year's net working capital minus last year's net working capital. Shift right, Command R. And we can finally solve for the company's unlevered free cash flow. I'll start at the top with EBIT. Starting with EBIT, you subtract the tax expense, then you add depreciation and amortization back. These are non-cash expenses. Subtract capital expenditures and subtract a change in net working capital. Shift right, Command R. These are the company's unlevered free cash flows. We're going to bring this back to the DCF page. It's the last thing we're going to be doing in this step. Shift right, Command R. And we can finally start working in step 3. Step 3 is calculate a weighted average cost of capital. Before we get started, the formula to calculate WACC is the weight of debt times the after-tax cost of debt plus the weight of equity times the cost of equity. We're first going to be filling in the company's capital structure up at the top. Capital structure is the way the company is financed, so financed through equity and debt. To fill in the equity value, use the company's market cap. Market cap is the total value of the company's outstanding shares of stock. To fill in the debt value, you go to the balance sheet and you add up their short-term plus their long-term debt. Now that we have the company's capital structure, we can get started with the debt portion of the WACC equation. Cost of debt is the effective interest rate the company pays for its borrowed funds. To solve for this, you go to the income statement, you take their interest expense, and you divide it by their total debt. Now, since interest expense is tax deductible, we use the after-tax cost of debt. To solve for this, it's the cost of debt times 1 minus the tax rate. The reason why we use 21% is because that's the corporate tax rate in the United States. Moving on to the weight of debt. To solve for this, take debt and divide by the capital structure. So the sum of debt and equity. We're going to be moving on to the equity portion. We're just going to be filling in these values. The risk-free rate is an investment that has no financial risk of loss. An example of this is the 10-year Treasury bond, which I just checked. It was at 4.2%. For the expected market return, I'm going to use 10%. This is the average return of the S&P 500. And then to solve for the company's market risk premium, you take the expected market return minus the risk-free rate. Moving on to beta. Beta is how volatile the stock is relative to the market. Microsoft's beta is 0.92 according to Yahoo Finance. Now we can use this to solve for the company's cost of equity by using the CAPM formula. CAPM stands for Capital Assets Pricing Model. Formula for this is the risk-free rate plus beta times the market risk premium, which is the expected market return minus the risk-free rate. Moving on to the weight of equity, you take equity and you divide by the capital structure. Now we have all the components to solve for the company's WACC. We do this by taking weight of debt times the after-tax cost of debt plus the weight of equity times the cost of equity. So we get a WACC of 9.37%. We can put this onto the DCF page. And with this, we can get started with step 4. Step 4 is determine a terminal value. The terminal value is the value of the company after the projection period. All we need is a growth rate to begin solving for this. Now for Microsoft, I'm going to use a growth rate of 5%, which is a little high, but since Microsoft is the largest company in the world, I think 5% works best. To actually calculate the terminal value, you take the last year's free cash flow times 1 plus the growth rate, and then you divide WACC, which we just solved for in step 3, minus the growth rate. This is the company's terminal value, and with this, we can move on to step 5. Step 5 is calculate present value and determine valuation. We're first going to be discounting the company's free cash flows. So the formula for this is the free cash flow divided by 1 plus the discount rate, or your WACC. We're going to absolute sell this so we can solve for future years. So click Fn, F4 to absolute sell the WACC value. Close the brackets, take it to the power of that year's projection year. So in this case, the first year. Shift right, Command R. And if you want to double check that you pulled the right values, like for instance the WACC, you can click Fn, F2 on any of the years. You can see that since we absolute sold it in the first year, it pulled the right values. Next, we're going to take a sum of all these free cash flows, so equals sum. Shift right. Now we're going to take the present value of the terminal value. We do a similar formula, it's just you take the terminal value, divide by 1 plus the discount rate to the power of the last year's unloaded free cash flow. So that's the only difference there. To solve for the company's enterprise value, you just sum up the present value of the free cash flows plus the present value of the terminal value. Now to arrive at the company's equity value from enterprise value, you first add cash. This is on the balance sheet. You subtract debt. This is on the WACC page. You subtract minority interest. This is on the income statement. So this is actually 0. Solve for it by actually doing these values. So enterprise value plus cash minus debt minus minority interest. Now that we have the equity value, to get an implied share price for our DCF, you just take the equity value, divide by total shares outstanding. And that is our implied share price for the DCF with all of our assumptions. Now, obviously, it's lower than Microsoft's actual share price, but this is just one valuation model. And as you can see, we did a lot of assumptions to get this value. But to get the actual percent of the implied upside or downside, you take the implied share price, remember your brackets, minus the actual share price, divided by the actual share price. So it's an implied downside of almost 18%, but we have a lot of assumptions, and we're going to be creating a sensitivity analysis table to show that if we were to change a couple assumptions, what the share price would look like. Hey guys, this is how to create a sensitivity analysis table. So if we were to change the WACC assumption and the company's growth rate, it'll show an implied share price reflecting these different changes. So we first input the implied share price right here. Next, we go to the growth rate, and right in the middle, we put the actual company's growth rate. So this is 5%. We're going to move up 0.5%, so 5.5%, 6%, go back down 0.5%, so 4.5%, 4%. Same thing for the WACC values, the actual WACC figure right in the middle, 9.37%, 9.87%, 10.37%, 8.87%, and 8.37%. Next, starting with the implied share price, shift right, shift down, then up at the top, click data, then what if analysis, data table, the row is the growth rate, the WACC is the column, click OK, and a bunch of different share prices arrive. So this shows the different changes. For instance, if our growth rate was 6% rather than 5%, and our WACC value was 8.37% rather than 9.37%, our implied share price would be $661 per share, which is far greater than Microsoft's actual share price. This shows that a DCF is more of a valuation range, just because there's so many assumptions that come into play. And this is all for the DCF valuation. So I really appreciate you guys watching, and please let me know if you have any questions.